Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach trading at Trading University. First market we'll take a look at will be the Australian US dollar. Aussie's in a pretty interesting position here. I think that our ratio says it all. Short term, your 5 and 10 day are higher. That's enough for us to be day trading that from the long side. So it's a good week buying dips in the Aussie. On the other hand, see that maroon line there, resistance, that's a big level. If the market can claw above there, that's going to shift both the 25 and 50 days simultaneously. That's a big shift for sure. What that means for us is not only will we continue to buy dips as day traders, but we'll buy dips as swing traders. We'll focus on the higher time frame charts to manage those trades also. So big level. On the other hand, you get a sell signal against that, and that's the other way. From a swing trader's perspective, a longer term trader's perspective, we're still selling rallies against that level. So big level there to watch in the Aussie. Next market, dollar Swiss. Dollar Swissy keeps on chugging higher. We called that the trade of the decade a few weeks ago. Really, no doubt about it, the investment of the decade. I keep showing you that long-term chart. From an intermediate and long-term perspective, there's just plenty of room on the upside for us. The one thing that could slow this market for right now is you're at the yearly high there. You can see 102 had been a pretty good resistance in the past. For me, if it does prove to be resistance again, you get a little backup. It's just another dip to buy along the way. We see this as a historic breakout in that market. So we continue to call that the investment of the decade for sure. Next market, dollar index. Similar to the Swissy, you're coming up on the yearly high, so you have resistance there. But if anything, from our perspective, that just means a potential dip in the market, and we love buying dips, and essentially that's our MO. It's really tough about the dollar index here is you couldn't shift that 5-day pattern. You would expect a little bit of a correction at the par level, at the 100 level. You had it. It was short-lived. If you look at it closely here, you'll see Thursday was the correction. You already closed above Thursday's high, so market's putting itself in a good position to motor through that 100 level. We'll have to see. All the talk is on the Fed. We think they're going to raise interest rates. There's no other way to analyze that, it being bullish for the dollar. So we anticipate a breakout of that 100 level. We continue to encourage our students, etc., to buy dips in this market in anticipation of higher prices. Next market, the euro. Euro continues to break down. Again, I'm a broken record, but you just have to continue to sell rallies in that market. You see the red box there. That's your 10-day pattern. Really, from a short-term trader's perspective, in order to even consider buying dips, you'd have to eclipse this level here at 109 and change. That's a long ways away from where you're at now. And the reason I point that out is to keep you on the short side. All your patterns are down here. It's not just the majority patterns. All the patterns are down. So we continue to sell rallies and press this market. We think that you'll see par in a hurry once the Fed announces that higher rate decision. So you still have a lot of room underneath that market. A potential sticking point, the 2015 low, right around 104. We think short term you'll see that, and we think once the Fed does what they're going to do, then the gates open to 100. So plenty of downside here for short and intermediate term traders. Here's the gold market. Gold, definitely a leading indicator market. And here's what's interesting to me. Gold made a lower low. Gold took out that the 2015 low already, made a new low. So we see that as bearish overall, certainly for this market, but also as a bit of an indicator for the euro, which hasn't quite made a lower low for the year yet, but we anticipate that being the case. Similar, the dollar Swiss and the dollar index itself to make a higher high. Given gold made the lower low, we think the other markets will follow suit, and that's what makes gold the leading indicator it is. Last market we'll cover will be U.S. interest rates. Here's the 10-year note here, and you can see the last couple of days yields start to stabilize. That looks like a bull flag to me. We think you'll have higher interest rates, and again, that's just supportive of our overall bull dollar theme. Bearish the euro, bearish gold. We think interest rates along with gold is definitely a leading indicator, and we see them as pointing to more of the same. Thank you so much. My name is Jay Norris. I teach trading at Trading University, and we'll see you next week.